Hello everyone. This is Microsoft Zira speaking on behalf of Narrowgate Trading. It's Monday, January 19th, 2026, and we've uploaded this video to explore an approach to designing a more or less set and forget Forex trade strategy by treating the Forex market like an atmosphere governed by objective dynamic principles instead of a machine driven by human psychology and collective investor emotions, where price operates like an aircraft flying through layers of air and liquidity is the medium that shapes its path. We use this system to enter a euro-dollar Japanese yen long position and to also buy the British pound Japanese yen. The idea is to use a framework that only takes trades when multiple layers of these winds are all blowing in the same direction, then to enter from a sensible pullback zone and let the larger currents carry the trade rather than micromanaging every wiggle. Instead of relying on arbitrary 20 or 50-period moving averages, this framework uses temporal baselines with percentage envelopes, so decisions are grounded in how far price can reasonably drift from its current flow, not in a fixed candle count. At the top of the structure sits the 2-week channel at 1% deviation, which acts as the prevailing trade wind and defines the global flow of a pair. If that channel is sloping up, the environment favors long positions. If it's sloping down, it favors shorts. If it's flat, there is no clear swing bias and the system stands aside. Just beneath this is the weekly channel at 0.7% deviation, a more regional wind that usually tracks the 2-week flow, but is undeniably less stable. When the weekly slope is unclear, the 2-week channel serves as the higher authority reference. The 3-day channel and the daily envelope at 0.5% deviation provide additional structural context. The 3-day measure is treated as a lagging indicator of the pair's eventual destination, while the daily envelope helps separate genuine directional moves from short-lived noise when mid-range channels look ambiguous. The heart of the swing engine consists of the 16-hour and 9-hour channels. The 16-hour price flow channel at 0.3% deviation functions like a local airstream that controls the main swing trade narrative, while the 9-hour channel at 0.15% deviation is the faster, more sensitive stream that picks up changes in the money-making price flow earlier, but is more unstable and less trustworthy in isolation. So then ideally, one should wait for the slopes of the 2-week, weekly, 16-hour, and 9-hour channels to line up in one direction before committing capital. When those slopes disagree or flatten out, the atmosphere is considered unstable and new swing trades are usually avoided. In this framework, economic news and data releases are likened to monsoon bursts. They may generate dramatic gusts, but as long as they do not permanently change the slopes of the major channels, they are treated as turbulence inside a stable larger weather pattern, not as a reason to panic out of well-structured trades. A typical high-quality setup begins with a counter-trend move against the established global wind. Imagine a pair where the 2-week, weekly, 3-day, and daily measures are all broadly sloping upward, signaling a bullish environment. Price may still sell off in the short term, drifting down toward the lower band of the 3-day envelope at roughly 0.7% deviation or the daily envelope at 0.5% deviation. That drawdown is treated as the aircraft descending into denser air rather than a full regime change. During this correction, the 9-hour and 16-hour channels may slope against the main uptrend. The trader does not enter yet. Instead, they wait for price to be rejected from those higher timeframe bands, and then for the 9-hour and 16-hour slopes to flip back into alignment with the bullish higher timeframe direction. The key is that after contacting those outer bands, the mid-range streams stop fighting the larger trend and rejoin it. This realignment of 9 and 16-hour slopes with the 2-week and weekly slopes is a concrete expression of temporal cohesion. The turbulence has passed, and all the winds are blowing the same way again. Once that temporal alignment is in place, the trader looks for a pullback entry using smaller envelopes instead of chasing price at extremes. The preferred entry location is the contrarian side of the 3.5-hour price range envelope at 0.12% deviation. In a bullish case, that means waiting for price to pull back toward the lower band of the 3.5-hour envelope, then entering a long position from that discount zone in the direction of the re-established uptrend. For shorts, the logic is flipped, with entries taken from the upper band of that envelope when the larger structure is bearish. If price is accelerating too quickly and never reaches the 3.5-hour band, the trader steps down a notch and uses the contrarian band of the 2-hour envelope at 0.1% deviation if the move is even more aggressive. The hourly channel at 0.07% deviation becomes the last resort tactical entry zone. These lower timeframe envelopes do not determine trend direction. They simply supply logical locations to step into the flow once the directional story has already been confirmed by higher layers. Risk management in this set and forget framework is meant to be mechanical rather than emotional. Stops are generally placed beyond the opposite side of the envelope being used for entry or, where appropriate, beyond the relevant higher timeframe band that would invalidate the trade idea. For instance, a buy taken from the lower band of the 3.5-hour envelope may use a stop just beyond that band and, if structure allows, below the lower edge of the daily envelope. Take profit targets can be set at the opposite bands of the daily or 3-day envelopes or at a predefined multiple of risk, as long as that target sits within realistic envelope bounds. Once a position is on with a defined stop and target, the trader's job is to let the structure work, rather than react to every news candle or intraday spike. The whole point is to let the larger air currents carry the trade after a well-timed entry, not to constantly re-steer the aircraft based on every minor gust. Exit rules tie directly back to the same mid-range channels that frame the trade. Positions are held as long as temporal alignment persists and the 9-hour and 16-hour channel slopes support the trade's direction. When these slopes clearly turn against the position and remain that way, the structural justification for the trade is considered broken, and the position is closed even if the original stop has not been hit. In addition, if cross-timeframe relationships devolve into what might be called temporal decoherence, where, for example, the 2-week channel is up, the weekly flattens, the 3-day goes sideways, and the 16 and 9-hour streams start whipsawing, new swing trades are avoided and existing positions may be managed more defensively. In that sense, the system stays engaged only when the air is orderly and coherent, and it stands down when the atmosphere turns chaotic. For a novice trader, the simplest way to think about this is that the job is to wait patiently until the jet stream, 2-week, the regional wind, weekly, and the local swing currents, 16 and 9-hour, are all pointing the same way. After a counter-trend dip or rally that tags a larger envelope and gets rejected, the trader enters in the direction of that unified flow from a pullback into the smaller envelopes, sets a sensible stop and target, and then mostly leaves the trade alone. As long as the mid-range winds keep supporting the position, the trade is allowed to ride. When those winds flip, the pilot lands the plane and waits for the next stretch of clean, stable air. We'll be watching the progress of the euro-yen and the cable-yen to see if they follow through and perhaps even continue on to hit our targets. In the meantime, let me wish you the best of luck. And until next time, if indeed there actually is a next time, stay awesome, but bye for now.